Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastep Jr.
Hello and welcome back to the Ask Ralph Show. My name is Ralph Eastep Jr. I'm an accountant in Middletown, Delaware. And I tell you, I have a passion for helping people, and that's why I do this radio show. I also take this radio show and we create podcasts from it. So if you're interested in learning more about finance, tax, or other things that I find interesting, then, check out our show every week. You can pick us up on Saturday mornings. You also can listen to our podcasts, and, that's the Ask Ralph podcast, and you can find those wherever you typically find your podcasts. So when you've got time, you want to go learn about something, we've got a pretty good library of podcasts out there with all kinds of topics on them. But today, I'm going to talk a little bit about business retirement plans. Now, if you're one of the people that works for somebody and you're fortunate enough to have a 401k, that is fantastic. That is a critical tool that's helping millions of people save for retirement. And those things are great. You just need to make sure you contribute to them. If you listen to me at all, you'll know that I always say put the maximum amount you can in. But let's say that you're self-employed. You don't work for somebody else. So, what are some ways that you can save money? So I'm going to talk about, basically three different types of savings vehicles. The first one is called a SEP IRA. And that's anyone with earned income can contribute to a traditional IRA. And those whose income doesn't exceed a certain threshold can save for retirement in a Roth IRA. You can do either one of those. Roth, after-tax money, grows, you take it out, no tax paid on it, versus a traditional. The problem with these options, though, is that you're limited to an annual contribution of $6,000 if you're less than 50 or $7,000 if you're 50 and older. So that doesn't give you that same benefit that the people who are working in more traditional jobs are able to put $19,000 away. So there's an alternative called a SEP IRA, which is short for a simplified employee pension. It's a retirement plan designed for self-employed workers and small business owners. Now, here's the cool thing about that. You can contribute 25% of your net business earnings. That means, basically your earnings minus your business expenses, up to a maximum of $56,000. That's huge. The only catch with a SEP IRA is if your business employs other people, you'll need to match the same contributions percentage-wise to your workers' accounts that you do on your own. So that means that if you choose to set aside 20% of your earnings in your own SEP, you'll need to then contribute 20% of each of your employees' earnings to his or her SEP as well. So that's where it becomes a little bit expensive if you've got employees. So the SEP IRA is great if you're a sole practitioner, a single person, not single from the standpoint of married, but single in the business. All those contributions go in tax-free, so that $56,000 maximum, and I'm not saying you're going to be able to do $56,000, but that certainly is something to reach towards. It goes in tax-free, so you get an instant tax savings. You get the return on your investment the day you do it. So whatever your tax rate is, that's your return on your investment. So let's say that you're concerned about the employee side of this. So then there's a thing called the Simple IRA, and we put a lot of our clients in Simple IRAs. If you employ other people and therefore can't afford to take advantage of the SEP IRA the way you would like to put $56,000 in, sure. One of the things you can do is a Simple IRA, which is short for Savings Incentive Match Plan for employees. Now, this one doesn't give you that 25% or $56,000 limit, but what it does give you is a $13,000 limit if you're under 50, and then $16,000 if you're 50 and over. Just like the SEP IRA, there is an obligation to fund the employees' accounts, but they're nowhere near as extreme. In fact, you must match your employees' contributions to their accounts directly up to a maximum of 3% of their compensation if they decide to contribute, or contribute a fixed 2% of their compensation to their accounts. The cool thing about this is you can contribute as both the employer and the employee. So basically, you could put that, if you're over 50, that's $16,000 in, plus you can do whatever that matching is. Again, these are made with pre-tax dollars, so it's going to save you that money, comes right off the top, right at the front end. Now, one of the other things that I've seen a few of these, when they first came out, I was a little bit confused by them, but the last thing here is what's called the Solo 401k. And this basically tries to take advantage of, a 401k plan like you would have in a traditional, employee-employer relationship. But the cool thing about this is you don't need to work for a large employer to gain access to a 401k. This is called the solo 401k. It works just like a traditional 401k at the contributions go in tax-free, thereby lowering your taxes at present. So again, it works the exact same way. But the cool thing about this is in a traditional 401ks max out at $19,000 for workers under 50 and $25,000 for those 50 and older. With a solo 401k, you can contribute up to 25% of your self-employment income. We're talking about, again, that's your self-employed earnings. Again, up to that maximum of $56,000. So just like the SEP IRA, you're able to contribute a lot more to it. Now, if you're over 50, then we're jumping up to $62,000. Again, now, this is only if it's just you. That's why they call it the solo 401k. There's no matching requirements and things like that. So if you have employees, that isn't going to work. The key to all of this, big picture, is if you're working and you're not putting money away for retirement, you are building a future problem for yourself. You're not going to live on Social Security alone. As much as I hate to say that, you're not going to. It's not going to work out for you. You're going to be very disappointed, and you're going to be short on money every month. That's just factually accurate. So if you're a small business person, you really need to consider some of these things. And the unfortunate part of it is, my practice is predominantly individual tax preparation, and then we have a ton of business clients, mostly small business clients. And I will tell you, for the most part, most of them have no savings for retirement whatsoever. They spend so much time building their business, which is great. But, one of the things you need to do is you need to put away for a rainy day. You need to put away for retirement. So this is something you should really consider, and you need to take the time to look at your options and see which one fits you best. At a very minimum, do a traditional IRA with a maximum of $6,000. If you can afford to go into the SEP IRA, you don't have other employees, that gives you a lot more room to put a lot more money away for retirement. And the coolest thing, like I said, is it's an immediate return on your investment. I always tell people, it's only costing you $7,000 to put $10,000 away. That's really the way you have to look at it. It's not just a federal tax savings, it's a state tax savings if you're living in Delaware. Now, Pennsylvania's a little different, but Delaware gives you that benefit. And then let's say you have a couple employees, then, maybe you don't want to have the problems with the traditional 401k where you've got testing and all this kind of stuff. And we didn't even talk about some of the vehicles, but, that maybe the simple IRA is best. And then again, like if you're just by yourself, you might want to consider the solo 401k. But the key to all of this is do something to put away for your retirement, because you're going to kick yourself down the road if you don't make an investment in your future. So I hope this was helpful with ways to save for retirement, and it's never too late to start. So start today.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.